Today we're looking at why silver still matters going into 2026. Not as a speculative gamble, but one of the most undervalued and misunderstood assets in the global financial system. Welcome to Money and Power. For years, many people assumed silver had lost relevance. They looked at the price charts, saw long stretches of sideways movement, and concluded the metal had somehow missed the boat. But that view is now completely outdated. Silver has recently staged an historic breakout, surging past previous nominal highs and trading well above $50 per ounce. This move is not a temporary spike. It reflects deeper forces that are beginning to reshape the metal's role in both the financial world and the industrial economy. Silver sits at the intersection of three powerful forces: monetary instability, industrial transformation, and structural supply tightness. And when you understand those forces, the recent breakout begins to make far more sense. To start with, silver remains a monetary metal even if it doesn't behave like one week to week. Whenever global debt expands at the levels we're seeing today, and we're now living through the highest debt era in human history, monetary metals eventually reprice to reflect the weakening of the currency value. Gold normally moves first and silver follows. We've already seen gold break into new territory, signaling that investors are quietly preparing for long-term monetary stress. Silver's recent surge is simply reaffirming its historical role as a leveraged companion to gold. Right now, the gold to silver ratio is around 70-1. While that's off its pandemic era extremes, it remains far above the modern historical average. Over decades, the typical range sits closer to 50 or 60-1. And when the ratio is elevated, it usually indicates that silver is undervalued relative to gold, even after a strong rally. Historically, that gap always closes, and when it closes, silver tends to move much faster than gold. The second major force behind silver's resurgence is industrial demand, and this is where things have changed dramatically. Silver is indispensable to the modern world. It remains the most conductive metal on Earth, both electrically and thermally, which means it is essential for high-performance technologies. Industrial fabrication is now forecast to surpass 700 million ounces in 2025, marking the highest in history and more than half of global consumption. Solar remains a dominant driver. The photovoltaic industry is still the single largest consumer of silver. Countries around the world are accelerating their renewable energy commitments, and silver is at the center of that transition. Even as manufacturers attempt to reduce silver usage per panel, the total installed capacity is growing far faster than efficiency gains can offset. Demand is rising and will continue rising. But the new growth engine is the AI revolution. People talk about artificial intelligence as if it's purely a software story. In reality, AI is a hardware story. Data centers, high-performance chips, advanced sensors, robotics, and machine learning infrastructure. These systems require large amounts of silver for electrical connections, signal integrity, and thermal management. The paradox is simple. The more digital our economy becomes, the more dependent it becomes on physical metals like silver. And then we get to supply, the third and perhaps most decisive force shaping silver's future. The silver market is now heading into its fifth consecutive structural deficit. For 5 years straight, demand has exceeded mined and recycled supply. Between 2021 and 2025, above-ground inventories have been drawn down by an estimated 820 million ounces. Almost an entire year of global mine production. That is extraordinary. Unlike gold, where nearly all mined ounces still exist, silver is consumed. Much of it ends up in landfills, electronic waste, solar panels, and industrial components where it's not economically viable to recover. Once used, it's gone. Silver mining itself faces structural challenges. The majority of silver production doesn't come from primary silver mines. It comes as a byproduct of mining zinc, lead, or copper. That means silver supply doesn't respond directly to silver prices. If copper demand slows, silver production can fall, even if silver rockets higher. This creates a scenario where rising demand meets an inelastic and sometimes declining supply base. That is the recipe for long-term price strength. These three forces, monetary stress, industrial acceleration, and structural supply deficits, form a picture that the market is only now beginning to appreciate. The fundamentals are not temporary. They are not cyclical. They are structural. So what does this mean for ordinary savers? First, silver should not be viewed as a short-term trade. It is volatile. It frustrates even experienced investors. It doesn't move on your schedule, but its long-term role is clear. It is part hedge, part insurance, and part asymmetric opportunity. You don't buy silver because it goes up every month. You buy it because when the financial system reprices risk, silver tends to do in weeks what other assets take years to accomplish. Second, silver works best alongside gold, not instead of it. Gold provides the stability, silver provides the leverage. When monetary pressure increases, silver amplifies the movement. That relationship has held true across multiple cycles. Third, focus on the gold to silver ratio rather than the daily price. When the ratio is extremely high, it historically marks long-term opportunity. The fact that the ratio remains elevated even after silver's breakout suggests that silver may still have considerable room to outperform gold. Fourth, recognize that silver is now driven by two independent engines, monetary demand and industrial demand. If monetary conditions worsen, silver benefits. If industrial demand rises, silver benefits. And right now, both engines are accelerating at the same time. Few assets have that dual structure. And finally, silver offers something increasingly rare in modern markets: true diversification. Stocks, bonds, and property all move in ways that are tightly linked to central bank policy, interest rates, and liquidity cycles. Silver, however, sits partly outside the ecosystem. It responds to physical supply and demand, not just financial flows. That independence gives it unique value in a world where traditional assets often move together. As we approach 2026, the key question isn't what silver will do next week or next month. The question is whether the forces driving silver are strengthening or weakening. And the evidence is overwhelming. They are strengthening. Monetary pressure is rising. Industrial reliance is escalating. Supply constraints are tightening. Analysts are beginning to project price targets between $60 and $80 per ounce over the next year. Nothing is guaranteed, but the structural case has rarely been stronger. If you found this clear and balanced look at silver helpful, please take a moment to like this video, subscribe to Money and Power, and tap the notification bell so you never miss an update. And tell me below, do you hold silver? And if so, what role does it play in your portfolio? Your insights genuinely help shape future videos. Thank you for watching.